So that's a perfect segue because the thing that we've all been talking about, but I don't think I've talked to you on a podcast about directly, and I want to ask this in the sort of broadest way possible about the future of fintech. Mr. Henrichs, what's the right way to regulate fintech? Because I think just to put some sort of bumpers around this topic, the idea that consumers shouldn't use fintech is preposterous and stupid and should
Yep.
never be said. I know that's
Genie
been
cannot be
uttered.
put back in the bottle.
No, and it ignores, as I think we've been talking around, a lot of the good things that fintech and banking as a service have done, right? And so we want these types of experiences and products, and just like focus and attention on certain customer segments. We want that in financial services.
Yeah.
That's a net benefit to financial services. So the answer cannot be don't work with fintech companies. And then within the wonderful dual banking system that we have, as I have written about recently, there are strange and conflicting forces that clash up against each other in ways that the average person might not fully even appreciate or observe. But those are also things we have to work around and work within. So within those constraints, which I know you understand very well, having lived in this world for decades, what's the answer? How do we regulate fintech?
This is probably going to shock you.
Yeah, I'm shocked.
I don't know that a fintech charter is the right way to go.
That's totally fair.
I don't know that we can figure it out.
Yeah.
Like, I see merit to the CSBS, Conference of State Bank Supervisors side of like, hey, we need pockets of bank charters within states that can do new and different things before they expand.
Yeah, move faster, right? Because like national regulators, as we've seen, they don't move fast.
No, do not move fast.
Right.
Here's what I think the right model is. I'm showing my age here. For people who were in venture in the early 2000s, there was a move on the London Stock Exchange in the AIM that you could go public on the AIM, but the way they did it for these small venture-backed companies that weren't big enough and profitable enough to get investment banker interest to do NASDAQ or New York Stock Exchange. And the way they did it is the FCA would basically regulate. You had to pay an investment bank that was your proxy regulator, and you could go public on the AIM. And what ended up working exceedingly well, right, is the investment bank in the middle avoided the adverse selection process, because if they screwed up and did not properly regulate you, they lost their entire business. And we're close to this. Like, we're very, very close to this. We're just not explicit about it, about what the state is. Here is the regulatory guideline that you need to meet, the burden of proof for how you act as a sub-regulator for us. And even if the fintech is paying, and this is where I think we screwed up in the US around this, is, yeah, the fintech can be paying you, but your business is dependent on you actually making sure they're compliant.
Yeah. So like any high, enough revenue that it gives me a financial incentive to do it, right? Because that's what you worry about in banking as a service, is regulation reaching the point where it's just not financially worth it for anyone to do it. So someone has to provide oversight and have a financial incentive to do that, but with severe enough consequences if you screw up that you do it in a careful way that selects for responsible entrepreneurs.
Yes. And this is a very frequent conversation among our banks in the Banking as a Service Center of Excellence at Alloy Labs. Is around pricing. Because you have a number of banks that don't understand the full cost of administering a program. And just as in the ZIRP days, you ended up with programs trying to negotiate compliance items and oversight. You're like, these are non-negotiables. Of course I have to oversee your marketing.
Right.
Of course I have to see your complaints. Like, those complaints are literally my complaints. It's my charter. If banks don't understand what it costs to administer this program, they're doing one of two things. Best case, they're a loss leader, and they're like, strategically, we want to own this, and therefore we're willing to take a loss. Or two, the more likely, they're cutting corners.
Right.
And so the banks that are doing it right, which there are a great number of banks that do this right.
There are.
And totally necessary. We have an upcoming episode on breaking banks with Gilles Gade from Cross River talking about consent orders are stepping stones, not stumbling blocks.
Yep.
Right? He looks at it, he goes, our mission around this has been, how do we actually extend credit to parties that otherwise would not have access to it? He goes, yep, we're the ones who surfaced. There was a fair lending issue. We found it. We own it. We're putting in a whole new set of controls around it.
Yep.
But it's upwards and onwards because we have the mission.
Yep. No, I think that sounds right. I like that model in terms of aligned incentives.